IMF has cut India's growth target, India's growth forecast by 30 basis points to 7%. Chief economist Geeta Gopinath says downward revision shows weaker than expected outlook for domestic demand. IMF, in fact, has also cut global growth forecast to 3.2% in 2019 and 3.5% in 2020. It's the fourth time in 9 months the IMF has cut its global economic forecast. IMF also suggests that tariff tensions will continue to hurt economies going forward. Here's a word coming in from Geeta Gopinath.
In China, the slight revision downwards reflects, in part, the higher tariffs imposed by the US on China in May, while the more significant revisions in India and Brazil reflect weaker than expected domestic demand. Among advanced economies, the US, Japan, UK, and the euro area grew faster than expected in the first quarter of 2019. However, some of the factors behind this, such as stronger inventory buildups, are transitory, and the momentum going forward is expected to be weaker, especially for countries reliant on external demand. A major downside risk to the outlook remains an escalation of trade and technology tensions that can significantly disrupt global supply chains.
That was the IMF chief economist, none other than Geeta Gopinath. Let's welcome in Dr. Ashuma Goel, member at PMEAC now, Professor, Indira Gandhi Institute of Development and Research. Ma'am, thank you so much for taking out time for us. What do you make of what Geeta Gopinath was just saying about growth, about dependence on external capital?
Yes, it is well recognized that India, there is a demand slowdown. And in fact, the IMF is behind because the Reserve Bank has also cut growth forecast for India. So has the Economic Survey. It's 7, and the IMF is following this to 7. So since in the Q4 growth came in at 5.8, if we reach 7, that means there is a turnaround expected, right? H1 has to grow at least 6.5%. So the positive thing is that it is recognized and there is at least monetary policy accommodation, some cut in interest rates. And I think that the investment slowdown that we saw had to do with the election, the government cut spending, and they should fast-track expenditure now with many ready projects. So a fiscal monetary stimulus, a reduction in uncertainty, and another major factor was really the slowdown in credit growth for households because of NBFCs. That really affected consumer durables. So there are some measures to improve credit flows to the economy to resolve the NBFC issue. So the next 2 quarters will be critical. We have to see if there is a turnaround. There is an external demand slowdown, and that means domestic demand has to compensate doubly. And India actually has an advantage in the sense that we are not so dependent on external demand. We have a large domestic market, as long as that's doing well, as long as domestic demand is revived.
You were talking about accommodation in the monetary policy also, but to what extent can it actually aid the larger issue that we're currently facing? Because in slowdown in investment, slowdown in consumption, these are issues that have been going on for almost 3 to 4 quarters nearly. So to what extent can that help cap the downside? And by when can we expect things like consumption or investment in infrastructure, investment in other industries pick up?
It's not just a question of interest rates, it's also liquidity because unfortunately last year there was a tightening of liquidity which coinciding with the NBFC crisis really hurt markets and credit growth. So now liquidity is in surplus and therefore the transmission of interest rate cuts is happening faster. And I think that consumer spending as well as housing loans, there is a slowdown in a lot of inventory build-up in unsold houses. So a fall in housing loans will really help this. I believe, and some research work we have done at IGIDEA shows that spending is sensitive to real interest rates. interest elasticity of consumption demand, investment demand is quite high in India, if it's measured properly.
Right. So you think that with these rates coming down in the system, RBI expected to cut rates going ahead, to spur growth. Sooner or later, with a lag effect, there will be a pickup?
Yes, I think so. As I was saying, it's crucial what happens in the next 2 quarters because the election is over. We should see a big jump in government spending. And see, the government has stuck to its fiscal deficit target, but even holding to that, it can revive because there was a slowdown in spending before the election. There can be a jump in government spending over the next 2 quarters, which can provide a stimulus, right, and can crowd in some private spending as uncertainty reduces. So what happens over the next 2 quarters will be critical. There are also some transfers to farmers, and which will boost consumption expenditure. Yeah, and the RBI has announced his move to neutral, which means that it is accommodative, which will also sort of set in expectations of softening interest rates, which will stimulate spending.
Right. Ma'am, just a word to understand the auto slowdown. Now, we've seen an auto slowdown which has happened, but even globally, we've seen all auto companies reporting bad numbers. Do you think it's not only an interest rate phenomena, it's some other thing that's happening and the entire auto industry worldwide is adjusting to some changes?
There are some longer-term issues, such as moving towards electric vehicles, etc., stronger sort of fuel emission norms, but auto is just one industry. So I think one of the strengths in India, which is not well recognized, is that we have quite a diversified system by now. So even though one industry might be facing a slowdown, others could come up. For example, the current expenditure on stimulus given for low-income housing. In India, we have the advantage of young people. We still have that. They want to buy new houses. They have to equip them. They have to buy a whole lot of things to equip them. So even if there's a movement away from private cars, and in some ways this is desirable because in India we are very vulnerable to oil imports. It's a large part of our current account deficit. So switching away from that is actually a positive for India's growth in the long run.
All right, ma'am. Thanks so much for taking out time for us, telling us what do you make of the statements, how do you see things going ahead.